So we are looking at another 15-mark question called Mlima. And of course, if you got the requirements, you can see that the requirements are, the first one is to prepare a report, the board, which explains why Mlima's directors are of the opinion that Mlima's cost of capital should be based on Ziwa's ungeared cost of equity, and showing relevant calculations estimate the appropriate cost of capital for Mlima. So, of course, here you have two things. You are going to explain why we should use Ziwa's cost of equity, which is ungeared, and then you also now calculate the cost of capital from Mlima. Now, when you see the word ungeared cost of equity, the first thing that runs your mind should be the first formula on the formula sheet in your paper, which is, if you look at it, is Modigliani and Miller's proportion with tax. So, because when they say cost of equity and they say ungeared, that's what they usually want you to be using to calculate. So, but of course, when we find that we don't have enough information to give us that computation, we might use something else. But for now, we are going to, first of all, go with the assumption that we are going to use that. So, for 8 marks. So, then we go to the next question, which says that estimate Mlima's value without undertaking Bahati project. So before they take the Bahari project, and then also with the Bahari project as part of them. So the valuation should be, I should use the free cash flow methodology, and the cost of capital calculated in part 1 should include relevant calculations. So the cost that you are getting from part A, Roman 1, is going to be used in Roman 2 for the free cash flows discount. So which means that the entire part of this question is going to be this 18 marks plus this 7 marks. Everything is mostly coming together with the calculation, because then you have to advise the board whether or not unsecured bondholders are likely to accept the equity for debt swap offer. So, and they're saying include relevant calculations for that. So there is something to do with equity for debt swap. Of course, when you see it, before even you read, that is usually when you exchange your debt and they give you shares instead of having the debt. So those people who were unsecured bondholders, would they be amenable to accepting that? That's what they're asking you here. Of course, it is going to come down to what returns are they getting vis-a-vis what they have been getting before, and other factors. So then, as the last part of the report, you also advise the board on the listing and the possible share price range if a total of 100 million shares will be issued. So you should include their assumptions made in estimating the share price range. Then also reasons that are mentioned above in the scenario, you also mention them, but you also give another explanation on the other possible reasons for changing the status from a private to listed company. And finally, an assessment of the possible reasons for issuing the share price at a discount for the initial listing. So now this part for 9 marks is basically asking you about how shares are issued. And of course, this is knowledge that you should have carried forward from financial management, but you may already know these things from other sectors of other parts of the syllabus, or even other papers. And then finally, for part B, discuss the possible impact and response of Mlima, the following ethical issues with respect to the Bahari project. So there's relocation of farmers, relationship between Bahari president and Myanmar's chief executive officer. So Now, and they're saying total marks will be split equally between each part in B. So it means that 3 marks for the relocation of farmers, and then 3 marks for relationship between Bahari president and Mlima chief executive. And we're supposed to discuss the possible impact and response of the Mlima to the following issues. So we are going to read the scenario and probably find all these issues in there. And therefore, our task is going to be now to give an explanation of how that's going to impact and also how the responses should be made. So, so let us go to the scenario and see what the scenario is all about. So it's a long scenario like the section A numbers that we have come to know. So it's going to take us some time to go through. Of course, when they give you this exam and it has 3 hours, 15 minutes, the 15 minutes are for preparation, and you normally, that's when I used to read the scenario. So that, because I know with ACCA you do every number, so it's not like you are looking for which numbers to do and which not to do. So better to use that time to read the scenario of section A and get to understand what you're going to do with the question, what information you have, and all those other aspects. What formulas do you need, and get them very fast. So, Mlima is a private company. So this is why they're asking us things about listing and all that, because it's not yet listed. And it does aluminum mining. So 8 years ago, it was bought out by its management and employees through a leveraged buyout. It's another type of buyout, leveraged buyout. Usually what it means is that you want to buy the company. So it was bought by the management and the employees. But you see, when you say leveraged, because they don't usually have money to buy the company outright, so they go and get a lot of debt. So they get a lot of debt to buy the company. So that means the company has a lot of gearing in that regard. Due to the high metal prices worldwide, the company has been growing successfully since the leveraged buyout. However, because the company has significant debt borrowings, that is what we said, with strict rates of excessive restrictive covenants and high interest levels, it has had to reject a number of profitable projects. So now remember, when you are accepting a project, you accept it if it gives you a positive NPV, which is got using a cost of capital. So if you are having so much gearing, that means that your cost of capital is going to be potentially high. Remember the Mugian and Miller's propositions where we said that if there is tax, it's going to be cheaper for you to have debt. But the traditional view is that if you have so much debt, then the cost of equity becomes high, and therefore the cost of capital also can become high. So that's why they are in this position. So the company has currently 2 bonds in issue. There's the one of 16%, secured bond, nominal value of 80 million, redeemable at par in 5 years' time. And there is an early redemption option. Option is to redeem the bonds at par immediately if it wants to. Okay, so redeeming the bonds at par immediately if you want to for these bonds. Then we do have an unsecured bond of 13%. Unsecured. So this one, nominal value 40 million, and it's redeemable in 10 years' time. So this is the one they asked us whether those people would be amenable to actually getting their shares or their debt exchange for shares. Now, the board has been trying to explore how to redeem both bonds, provide the flexibility that it needs when making future investment decisions. So to do so, it has decided to consider a public listing on the company on the major stock exchange. So a total of 100 million shares will be issued in the newly listed company. And from that, 20% will be sold to the public, 10% offered with the holders of the unsecured bond in exchange for redeeming the bond through an or equity for debt swap, and the remaining 70% will remain in the hands of the current owners. So this is how they are going to do the share. So 100 million shares, 20% public, 10% the unsecured debt holders, and 70% remain in the current owners. So remember, the current owners right now have 100%, but they will still remain majority shareholders. So they will still sort of control the company, which is something that you may talk about when we are discussing whether they will accept that share exchange. So now, the secured bond would be paid out of the funds raised from the listing. So for them, they would pay them out and they go away. And then the secured bonds will be replaced by equity. So details of the possible listing and the distribution of the equity were published in national newspaper recently. As a result, potential investors stated that due to the small portion of the shares offered to the public and for other reasons, the share should be offered at a substantial discount as much as 20% below the expected share price. So this they said amongst the reasons that are discussed above, give more reasons. So they say the reason that is given by the investors is that because of a small proportion of the shares offered to the public and for other reasons. Okay, so the other reasons are the ones they're also asking you to do. And they want to offer at a discount of 20% below the expected share price. Now, when you offer your shares at a discount, they are basically asking why should we do so. So the most obvious point here is that when you offer your shares at discount, you don't get as much money as you hope to get. So that's a bad thing. However, because you are offering that share at a price which is lower than the actual value that you expect it should be valued at, shortly after you issue those shares will gain value. And those people who bought the shares will benefit by getting a very fast share price increase. And that share price increase, if it sends the right signal, it's going to keep on increasing. So it's always good to do that, as opposed to overpricing the shares and getting maybe again fewer people buying because they are more expensive, which may also not solve your problem. But also because you overprice them, the market is going to regularize, and at the end of the day, you may find that the share price falls, which is a bad sign for public listing. You want to issue your shares and at least they start increasing right away, but not decrease. So, of course, I've given you that, but we shall find other reasons. We shall discuss other reasons as we go. Then the finances of Mlima after the listing, the strategies and greater financial flexibility will boost Mlima's future sales revenue for the next 4 years. So we are going to do this thing for the next 4 years and then afterwards. So now, they're saying that the annual growth rate will be 120% of the previous 2 years average growth rate. So now, that is a very big assumption. So remember, when you are discussing these kinds of questions, you have to say, okay, the assumptions that are made sometimes are not realistic. Now, this is a growth of 120% over the previous 2 years average growth rate. And then after the 4 years, annual growth rate of the free cash flows to the company will be 3.5 after the 4 years. So, for the foreseeable future, operating profit margins are going to be maintained in the future. So, we need to determine in which margins they are there now. Although it has been assumed that the current tax allowable depreciation is equivalent to the amount of investment needed to maintain the current level of operations. So, this statement, I hope by now you know whenever you see it what it means. It means do not add back depreciation, because even if you add it back, there is another investment in non-current assets, the same figure that you subtract. So that's how they cancel each other. But we shall require an additional investment in assets of 30 cents per dollar increase in revenue for the next 4 years. So then they give us the financials for the past 3 years. They give us revenue, operating profit, and net interest costs. Then they give us profit before tax, and then they give us tax and profit after tax. Also, once listed, we shall be able to borrow future debt at an interest rate of 7%, which is only 3% higher than the risk-free rate of return. So we shall be able to borrow at 7%. Now, here they have given you also the risk-free rate, because the risk-free rate is 3% lower than 7%. So it's actually 4%. And it also wants to raise any new debt after listing, but any future debt will carry considerably fewer restrictive covenants. However, these plans do not consider the Bahari project, which is also being considered here. So now the second question was asking us to calculate before the project and after the project. So if you have been following and you want to do the before the project right now, you could go do that. But as usual, advice is that you read the whole scenario as you are picking information that is key, then you start attempting. So the Bahari project is given to you. Bahari is a small country with agriculture as its main economic activity. So they have done some survey, and they conclude that there may be a rich deposit of copper available to be mined in the northeast of the country. So this is copper. Remember, we are dealing in aluminum. So that's a very different business venture from what we are accustomed to. And that's what they asked you as one of the questions. The first question is, why should we use the ungeared cost of equity of another company? And first of all, the reason is going to be because our project that we are trying to do is different from the project that the normal business activity that we operate in. So, because it's a different deposit of copper, which is not aluminum, but also it's in a different country, and other reasons that we are going to find. Another reason that we talk about ethical issues is that there is already people who are farming on that area, and we have to relocate them. So this is the last part of the question which they are asking about the ethical issues. So when the results of the survey were announced, some farmers protested that the proposed farmland where they would be moved was less fertile and that their communities were being broken up. Okay, so we have to address those issues. However, the protesters were intimidated. This is another problem. Intimidated and violently put down by the government. Although this was not what was done by our company, it was done by the government of Bahari. But there is still going to be issues for us because we don't want to be seen as associated with a country whose government is oppressive. So, and the state-controlled media stopped reporting about them. Soon after that, their protests were ignored and forgotten. So this is a very big ethical issue for the company to consider. As long as that issue exists and they have not addressed it, they may have issues with the public and also with their shareholders that maybe have ethics at their mind. Okay. So also there was a meeting with the government of Bahari and the Mlima Co board of directors, and the government offered Mlima exclusive rights to mine copper. Okay, the government offered exclusive rights. So there are enough deposits to last at least for 15 years. Initial estimates suggest that the project will generate free cash flows of 4 million in the first year. So free cash flows of 4 million in the first year, rising by 100% per year in each of the next 2 years, and then by 15% in each of the 2 years after that. Then the free cash flows then will be stabilized at the end of year 5 for the remaining 20 years. So stabilized means they're not going to be changing. They won't be growing, they will just keep stabilized at that point. Now, the cost of the project is going to be $150 million, comprising machinery, working capital, and the mining rights fee payable to the Bahari government. And none of those costs is recoverable at the end of the project's 15-year life. So which means that even working capital is not recoverable. The government has offered a subsidized loan. So there's a subsidized loan over 15 years of the full 150 million at an interest rate of 3% instead of the normal borrowing rate of 7%. The interest payable is allowable for taxation purposes. Can be assumed that Mlima's business risk is not expected to change as a result of undertaking the Bahari project. Now, they are saying that the changes won't happen. The cost of business risk is not going to change when you're undertaking the new project. Now, you have to suggest that that's not possible or that is not likely because they are doing a different mineral altogether. They are doing copper, and we have been used to aluminum, but also the project is going to probably affect the gearing, and also the risk is going to be there because of the other factors we have seen, the ethical issues and all that. So really, we have to consider that. After the conclusion of the meeting, the president commented on that working together would be like old times when he and Mlima's chief executive used to run a business together. Now, this is another ethical issue. You don't want to be seen as getting a project solely because you worked together with someone during those old times. Because then the public may not see you as looking after their interests, since you are maybe satisfying your buddy that you used to work with. So it's also going to be a challenge of sorts. So then we have other information. We have a competitor from Mlima, which is Ziwa. And Ziwa is listed and it operates metals worldwide. So the directors are of the opinion that after listing, the cost of capital should be based on Ziwa's ungeared cost of equity. So Ziwa's cost of capital is about 9.4%. Then the cost of equity, which is geared, is 16.83. And the pre-tax cost of debt is 4.76. These costs are based on a capital structure comprising of 200 million shares trading at $7 each, and 1,700 million 5% redeemable bonds trading at 105 per $100. So both Ziwa and Mlima pay tax at annual interest rate of 25% on their taxable profits. Tax is 25%. Then all the cash flows will be dollars instead of the Bahari currency. Therefore, Mlima does not have to take account of any foreign exchange exposure from this venture. Again, when you are answering, you should say, okay, well and good, but this company, Bahari, this country, Bahari, probably uses a different currency from us. Therefore, we may even have some FX exposure, although we are downplaying it at the moment, saying we should just use dollars. So that is showing some skepticism as we go. So now let's get into the question and start answering the first part. So the first part, just to reiterate, wants us to prepare a report. So means that what you're going to do is that you're going to say report to, and then you start doing the, remember, as we said, you write the content of the report in a Word, and then you write you get the appendices in Excel. So now the first question is to explain why directors are saying that we should use the ungeared cost of equity, showing the relevant calculations and all that. So now, the first thing that you need to remember as part of the explanation is that remember that we are going to basically move away with all of the debt. We are going to get all of the debt away from our company, Mlima. We are going to replace the unsecured debt with equity, and we are going to pay off the secured debt, which means that ultimately we shall be left with only equity in our company. That's one thing. The other thing is we can't just use the cost of equity for any company, because that company's cost of equity will be affected by the level of gearing they have. Because remember what we said, that if the shareholders see that we have so much debt, then they will think of it that maybe the company is more risky, then they will ask a higher return. So that's why we have the ungeared cost of equity, to kind of remove the gearing aspects from it. So when they remove it, then we are able to use that cost of equity as the one that represents our company. And the reason why that's the case is that we assume, since we are in the same industry, we have similar business risks, and also we kind of have similar operations in terms of what we are doing. Although this company is working worldwide, so you may talk about that aspect, that because it's working worldwide, and for us we are still like just in one country for now, we are not listed like they are. You cast some doubt on the accuracy of the results that we are going to get. But that's the first point to make. So as to the calculation of the cost of capital, let us go to get that. So, Mlima, cost of capital. So remember, you said that we start with Ziwa. So Ziwa, they told us that Ziwa's ungeared cost of equity is what we are going to use. So they have the cost of capital, 9.4%. Let me actually just use work, 9.4%. Then the cost of equity, which is geared, 16.83%. And then cost of debt, 4.76%. Then we have value of equity, value of debt. So value of equity, 200 million shares at $7 each. So which gives us 1.4 billion, and value of debt, 1,700 million, 5% at 105. So 1,700 times 105 divided by 100. So this is the value of the debt. So having known that, now remember the formula that we are going to use. If I'm to bring it from the formula sheet, I already showed it to you. So now this formula here says that to get the cost of equity of a company, you get its ungeared cost of equity. So the one which has I is ungeared. Then you add 1 minus t multiplied by KEI minus KD, then VD over VE. So that's what we have. Now, unfortunately, this formula, if you try to make KEI the subject, no, you can make it the subject. You can make it the subject, but you don't have to go through that struggle. Because if I'm to make it the subject, it will be at KEI, okay? Let's first write it down here. So KE is you're going to say 16.83% is equal to, because that is the KE. So we need KEI, we don't know KEI, then plus 1 minus T. Now remember that they say that the tax that they are paying is 25%. So tax is 25%. So KEI plus, so 1 minus, that's going to be 75%. Multiplied by KEI minus 4.76%. Okay, multiplied by 1.785. So multiplied by, what we can do to simplify this is that let's get it VD over VE. VE over VE is about 1.275. So multiplied by 1.275. So, yeah. So now this is the formula. So all that you need to do now is to make it, so that is going to be 16.83% is equal to KEI plus 75% KEI minus 75% times 4.76%. Now remember, this one is multiplying both of these, right? So which means that here we have to multiply this thing by 1.275, even this one. So now you could do the math and not leave them like this. I'm just trying to maintain accuracy, but you can see that from here I correct the KEIs. So KEIs, so I'm going to have here 1 plus 75% times 1.275. Okay, that is KEI being equal to, so I'm going to have 16.83%. Now this one's going to go upside, plus 75% times 4.76% times 1.275. Therefore, KEI is going to be, now I can now say 16.83% plus 75% times 7.76% times 1.275 divided by 1 plus 75% times 1.275. So that is KEI. And if I've done it right, because there's that risk, but if I've done it right, KEI is actually 12.8%. 12.4%. So just let's run through it and see that we have not made a mistake. Then we can confirm what we have got. So 16.83 is equal to KEI plus 75% times KEI minus 4.76 divided by VD over VE. So this is VD over VE, which is 1.75. Then we expanded it by saying KEI plus 75% KEI times 1.275 minus 75% times 4.76 times 1.275. Then we have now 1 plus 75% times 1.275 KEI being equal to 16.83%. Now this one becomes plus 75% or times 4.76, not 7, times 4.76 times 1.25, which means that you bring this one, and here this is also 4.76. So let's just correct that from 7 to 4. Yeah, 10.93%. So this is KEI. Now, of course, what you're going to do, what you have just done here is making the subject. This is pure mathematics, just arranging the formulas and all that. So in case it's confusing you right now, we go back and sit down and look at this formula and see how best you can get KEI. If you want, you can make it the subject by opening up everything, correcting things up, then you get a formula that you will use so that you know this is the formula. But in case they want me to get KEI, I have another formula for myself that I can use. Because this is the formula right here. You can arrange it such that you know what you're talking about. But that's the cost that we are going to use for our new company. So that is what answers the first part of the question. Explain, we have explained, and then we have calculated the cost that we would use. Is that fine before we go to the second part?
Yes.
Okay.
Yeah.
So then we got the second part. Second part wants us to get the value of Mlima without undertaking the project and then after taking the project. So remember, they told us that before the project is undertaken, they gave us information of the financials and also how things are going to be once we have once we have the cash flows flowing from year 4 onwards. Now, what we are going to first of all see, because the way they told us is that the growth in revenue for the next 4 years is going to be 120% of the previous 2 years average growth rate, which means that we need to know what was the previous average growth rate. So what is the historic average growth in revenue? Now remember, they gave us information. They gave us information for revenue for.
But
Yes.
is that now another appendix when we're answering the question?
Yes. If we label the appendices, this one will be appendix 1. So what you normally do to figure out which appendices to use, the very first thing should be in terms of the questions, how they are laid out, but also the appendix should be thematic. Now the appendix 1 has been answering the cost of capital for this company. So now appendix 2, since we have these 2 scenarios whereby we look at before and after, we are going to have appendix 2 talk about the project value before, and then the appendix 3 should talk about the project value after. So you don't want to mix those two things in one appendix. You could, but you would like to have it thematic in that way. So yeah. So appendix 2, value of Mlima before the Bahari project. So now we have been given revenue information. They gave us for 2003, 2001. So we have 20x3, 20x1 revenue. So they gave us 389.1. Then also gave us 344.7. So as I told you, whenever you're doing this calculation for the average growth, you just need the earliest and the latest year. And how many years of growth? Because we came from 1 to 2 and then 2 to 3. So those are 2 years of growth. So the growth is going to be, so you get the one of 2x3 divided by the one of 2x1. Then you say power 1 over 2, because there are 2 years of growth, then subtract 1. So revenue has been growing at about 6.25% historically. But then they said that now the new one is going to be 120%. It's going to be 120% of the previous 2 years' growth, right? So the new growth for next 4 years is going to be 120% of 6.25, which becomes 7.49%. And then it will grow from there after the 4 years. Yes.
I'm sorry to take you back. Can you please just go back to the formula where we computed the historic average growth rate?
Yes.
Yeah, just want to. We are getting
the latest, which is 2000x3, divided by the earliest. Then you power 1 over how many years of growth? So from x1 to x3, there are 2 years of growth, yes. Then you subtract 1. The reason you subtract 1 is because when you don't subtract 1, what you get is usually 106. It's 1 plus something. So we subtract the 1 to make it a growth percentage. So those are the growth that we have. This is 7.49. Yes.
But is that formula given anywhere, or we just have to learn it?
We have used it several times when we are doing most of the revision questions that have growth in them. It is not given on the formula sheet. You just have to know it. Okay. So now we have our growth, so we can now set up our cash flows. Because we know the sales revenue growth. They also say that the operating profit margins are going to be maintained. So the operating profit margin, if you look at what we have the operating profits and the sales. So you can get the margins. However, when you look at what we have, if I'm to take just this part, something has happened after. If you look at the operating margins, you can see that the problem is that we have 3 years. And if you look at the 3 years, if you get 58.4 divided by 389.1, you get a margin of 15%. 15 point so many numbers percent. If you get 54.9 divided by 366.3, you also get 14.9%. And if you get 51.9 or 0.7 divided by 344.7, you get 14.9%. Now, these ones, yes?
Sorry, I stopped following at what? At the new growth rate for the next 4 years. The 7.49.
Yes.
I don't know where we have gotten this 3.5.
This was given to us. They said that after the 4 years, the annual growth rate of the free cash flows will be 3.5%. Yeah, so that one I just put it here. So now we are also getting the operating margin. And the margin is got by getting the operating profit divided by the sales revenue. And I was saying that when you look at it for the 3 years, they all rotate around 15%. Okay, so we can take 15%. But in some situations whereby you find they are a little bit different, you can get the average. Okay, you can get the average of them, or you can choose to use the most recent. Okay, the average here is 15% because they are all 15 around there. But you can choose to use the most recent operating margin, right? So, like, for example, if this one was 15 and this other was 17 and 20, maybe you would choose 15% for the latest year. You have to indicate it in the question that you have chosen to use the average, which is 15%. I mean, the latest figures. But here we are okay. We are going to use 15%. Now we can set up our cash flows. So we are going to start from year 0. So then we have up to year 4, then year 5 onwards. So then what we are going to need is to get the revenue. So the revenue, let us work in the current, in the precision that is given in the question, and our precision is in millions of dollars. So let's go and work here in millions of dollars. Now, which means that the revenue that we got of 389.1, we are going to have to grow it by this 7.49%. So we have 389.1 multiplied by 1 plus 7.49% power 1, because I'm going to drag the formula. So that's going to be the one for the first year. Then we drag it up to year 4. So yes, you keep the same precision that they kept in the solution. So that is for the first 4 years revenue.
Albert,
Yes.
please recap for me that part, revenue.
So revenue is going to be growing at 7.49%. So we start from the revenue of 2003, 389.1. So we grow it by 7.49. That is 1 plus 7.49%. So if you want, you can do it like that and you keep growing each year like that. But since the rate of growth is the same, you can just say power 1. And then you drag it, now goes power 2, power 3, power 4. But make sure that you have fixed this formula here of 7.49. Otherwise, if you drag and you didn't fix this part, it will move and you will get wrong things. Yeah. So now we can get our operating profit. Operating profit, they told us it is 15%. Again, you fix it and multiply it by the revenue. So this is going to be our operating profit for years 1 to 4. Then, as we said, we are trying to maintain the same kind of precision. So we are going to work with the 1 decimal place. Then from here, now we can get the tax at 25%. So 25% of the operating profit. Then normally when you finish doing tax, you do now add back depreciation. But they told us that we are going to have an investment in depreciation and in non-current assets, which is equivalent to the depreciation per year. So we are not going to do that, but we are going to get another additional investment, they said, of, was it? Let me first find it. Of 30 cents per $1 increase in revenue the next 4 years, which means the additional investment. So in the first case, revenue increased from, because remember it is 30 cents, so 0.3 multiplied by increase in revenue. So it increased from which figure, which we had 389.1 to 418.3. So that is the first additional investment. So it's not 0.0, it's just 0.3. So that is 8.7. Then now you drag the formula, but the formula is going to change a little bit because now we are going to start from the one of year 2 and then subtract the one of year 1. Then now we can drag it for the next 4 years, for the other 2 years. So that is our additional investment. And it's negative because it's an investment. Those are the additional investments. And of course, at this point, what is the initial investment? I think this project, these cash flows don't have initial investment. So we didn't need year 0. Because remember, since we are not looking at a new project, we are just saying what are our cash flows after we have done this realignment. So there is no need for year 0 in this case. So let me just remove it. So after getting additional investment, then we can now determine what our free cash flows are. So remember, we start from operating profit because we already added the things up. So these are our free cash flows. Now, the one after year 4, that is year 5 onwards, is going to use the one of year 4 multiplied by 1 plus the growth after 4 years, which is 3.5%, then divide it by the cost of capital minus the growth. So it's basically like the dividend growth model. So the cost of capital that we calculated was 10.93%. Okay. Now you could find yourself using 11% since you want to use tables, but I'm just going to keep the same 10.93% because I'm using Excel. I don't need to use tables. So I subtract this 3.5%. So that is the free cash flow after year 4, that is year 5 onwards. So from there, we now need to get the present value. So we need discount factors. So discount factor is 1 plus the cost of capital. Remember, it is 10.93%. So we are going to fix it. power minus n, which goes up to year 4. Now, from year 5 onward, we still use the one of year 4 because basically we have brought those cash flows until that point of year 4. So we discount them at that same, so we can now get our NPV. We still need first get present values by multiplying the free cash flows by the discount factor. So which gives us our NPV as the sum of these figures. So the value of the company is about 569 million. Okay, so this is the NPV, which is also the value of Mlima. Okay, 569 million. This is before the subsidized, before the other project that we are looking at. So then they asked us to get the value of the project after the Bahari. So remember that the Bahari thing, they say that there's going to be enough deposits for 15 years. The project generates free cash flows for 4 million in the first year, rising by 100% per year in the next 2 years, and then by 15% each of the 2 years after. Then after that, they will stabilize until the remaining 10 years. So we can lay out our years. So we can lay out so now this is appendix 3, value of Bahari, the value of Mlima after the Bahari project. So what we need to do, if you read this question, if you read this part here, you would see that there is a subsidized loan. So when there is a subsidized loan, you normally do what we call APV, adjusted present value. If you got a chance to look at the question that we attempted on Thursday, you saw that we have their adjusted present value also coming into play. So it is a very common type of question which you should be ready to answer. So to do it, what we normally do is first of all get what we call the base level NPV. That is the NPV which we do by considering only the cost of equity. And then we add there the financing side effects. So we now start with the best case NPV for Bahari project. So they say that the years, so we're going to need to have years 0, 1, 2, 3, 4, 5. It's supposed to be 15 years, but the information that they give us says the remaining 10 years, because remember they say that it's going to be in the first year 4 million, then it goes for each of the next 2 years, that is up to year 3, then 15% in the years that is 4 and 5, and then from there it stabilizes. So year 6 onwards, it's going to be stable, so no growth. Now what you're going to do is to get your so we have revenue. No, they gave us free cash flows, not even revenue. So just say free cash flows. So year 1, 4 million. So let's also here work in millions. So year 1, that is 4 million. Then it increases by 100%. Where is it? 100% in each of the next 2 years. So that means that this is 4 million multiplied by 1 plus 100%, which becomes 8. Then also increases by the same, which becomes 16 in the next year. And then from there, by 15%, so that is 18.4. 15% in the next 2 years. So that is going to be the same figure that it grows by another 15%. So 21.16. Now, it now becomes stable, which means that it's going to be 21.16 onwards. So it means that what we're going to do is get this one. Normally, we're supposed to say 1 plus growth, but there's no growth, which means that we are just going to divide this thing by the cost of equity. Now, the cost of equity that we are going to use is the same cost of equity, because they say that the one that we get up is the one we should use for this project of 10.93%. So which gives us about 193. So that 193 that we get, then we can now discount. So discount factor, we are,
Please put the cursor on the 193.
just divide by the cost of equity of 10.9%. Because remember, it would have been like what we did for this part here, but there's no growth. So when you remove growth from this formula, you end up by just dividing by the cost of equity. Okay?
What's the growth rate after year 2?
After year 2, 15%.
15.
Yeah. No, the first one was 4 million, then it was growing at 15% for year 2 and year 3.
Yes.
Then after year 3 is when it becomes 15%.
Okay.
Yeah.
Thank you.
Okay. So just to make it uniform, now this project, there is going to be 150 million as the, so 150 million. So we can actually bring the cost before we bring a discount factor. So 150 million, which we can also, so it will be 150 million, and it will buy machinery. Yes.
The cost of equity we have divided with is the 10 point something percent we got.
Yeah, 10.93%. Yes.
Only that I get it different. I think it's okay. Thank you.
What do you get? Because remember,
I think my 10, I got 10.372 something.
Oh, the rounding
That's
things.
Right. Yeah.
But the answer that you get here is not very different from 193.
I'm getting 200.
It's fine. It's very fine.
Okay.
Yeah. So the cost of the project is 15 million. Then now we are going to have, 150 million. Now we bring the discount factor, the discounting. So which is going to be 1 plus the cost of equity of 10.93% power minus n. Then you drag it up to year 5. And then the one of year 6 onwards is the same as the one of year 5. So those are discount factors. And you can get the present value as the, so I'm just going to, because I didn't sum up, so I'm just going to get the free cash flows and the cost and multiply it by the discount factor. Okay. Okay, so these are our present values. Then we can get our NPV. So this is our NPV. It's about 12 million. This is the best case NPV, right? Is it 12 million? First word is, oh, sorry, there is a mistake we did here on the year 6 onwards. This is not perpetuity. This one goes on, but it goes on up to 15 years. The project is for 15 years, not forever. So on this one here, we say, let's say year 6 to 15, so that we don't say onwards. Year 6 to 15. So when you say year 6 to 15, now it changes how to get this cash flow, because what you're going to do, since you are going to get 21.2 for the next 10 years, so you basically get 21.2, then multiply it by the annuity factor, which is going to be 1 minus 1 plus the discount factor of, the rate of 10.93% power minus 10 divided by 10.93%. Then you close the bracket. Okay, so just to repeat, this next part was not going for year 6 to infinity, it was going to year 6 to 15. And therefore, we have to create and calculate an annuity for this 21.2 for the next 10 years. So this is the formula for annuity factor. So this gives you 74. So now when you have 74, so then you are going to now discount it back using the discount factor, like we said, of year 5. So then you have your NPV as 29, and you can see that it's negative. So it means that had you just used the maybe equity for this financing, you would not take this project. But now we need to bring the financing side effects. Now, the financing side effects usually are going to be the tax shield. It's going to be the benefit that we have as a subsidy. And sometimes in other questions, you would have the so-called the issue costs. But here, they didn't give us issue costs. They just said that the government has offered a subsidized loan over the 15 years at 3% instead of the normal 7%. So the interest payable is allowable for taxation purposes. Now, what we are going to do is get the present value of tax shield and then the present value of loan subsidy. And we add those ones to our NPV. So tax shield Now, what you need to remember is that instead of paying the 7%, we are paying 3%. So it means that we are actually saving 7% minus 3%. But of what? Now, the loan that we are getting, how much is the loan? Is the 150 million that we are going to have to invest. So 150 million multiplied by the difference between the 7% and the 3%. And then the tax that we should be paying on that is 25%. So that is the cash flow itself. But that cash flow is going to occur for 15 years. So we have to deal with it using the annuity factor for 15 years, which I can calculate here as 1 minus 1 plus the discount factor of 10.93% power minus 15, then divide by 10.93%. So let's see. That's the annuity factor. So many brackets. I hope I'm not making a mistake somewhere with those brackets.
Please recap.
Okay, so maybe we can calculate the annuity factor on itself. Let's firstly bring these figures. Let's make a working so that you understand the whole process, right? So we need to get the present value of tax shield and the one of the loan subsidy. So let's create here the tax shield. So the tax shield is going to occur in year 1. Everything is occurring in year 1 to 15. So tax shield is going to be 150 million multiplied by, instead of paying 7%, we are paying 3%. And we are paying tax at 25%. So that's the tax shield that we are saving every year, 1.5 million for 15 years. Okay. Then the loan subsidy. Now the loan subsidy is what we are talking about for the loan subsidy is that actually that what I captured was the loan subsidy. This is the loan subsidy is that we are getting a saving on our loan. So let's just repeat this. Tax shield is going to be on the interest we are paying, and we are paying 150 million, and we are paying 3%. 3% as the interest, and then we are saving tax at 25%. So that is the tax shield. Okay, 1.125 million. Now the loan subsidy comes in that we would have been paying 7%, but now we are paying only 3%. So there is a 4% subsidy that they are giving us. Now that's 4% subsidy. We are not benefiting from all of it because we are also losing some tax shield, because if we had been paying 7%, we would have been getting a tax shield of 7%, but now we are only getting 4%. So we subtract 1 minus the tax, or we multiply by 1 minus the tax of 25%. So that's the benefit that we are getting of the loan subsidy of 4.5. Now, the annuity factors for 15 years. Because these figures are going to occur for 15 years. So annuity factor for 15 years, we can now calculate it as 1 minus 1 plus 10.93% power minus 15 divided by 10.93%. So this is the annuity factor of 7.2219%. Then I'm just going to fix these figures up so that I can drag. So when I drag, now I can get the present values of these things. Multiply the tax shield by the annuity factor, and same with the loan subsidy. Okay, is that clear now?
It's better. Thank you.
Okay, yeah, I think it's better when you break it down. Then you can now bring the figure here. Tax shield is 8 million, loan subsidy is 32 million. So now from here, you can get what we call adjusted present value. So which is basically the sum of the NPV and the financing side effects. Now, in some cases, you are going to find that you have some issue costs, but here we didn't have. Okay, so we are going to just deal with this. So adjusted present value becomes 12 million. Now you can say that before the project was giving us a negative NPV when we were using all equity, but by the fact that we have used now, we are going to get some subsidized loan. So the financing side effects kind of bring it back to a figure that is more sensible to understand. And therefore, on the basis of if it comes to accepting or rejecting the project, you will accept the project using, you are going to use the NPV, which is before you adjust for financing effects, and then you add the as financing effects. So gives a positive NPV. So you should take the project. Now, remember, we want the value of Mlima. So the value of Mlima, you're going to do what? To calculate it based on. So this was the value of 569.5 million. But now you are going to add this 12 million. Okay, value of Mlima after project will be the 569.5 million now plus what you are going to get from this project. So this is in millions. So now at least we can see that there has been some value created. Now, the third part, now that we are going without a break because the question is long and I don't want to leave it unfinished. I hope you are okay with that. You are?
Yes.
Okay. So now we got the third part, which looks at whether these unsecured bondholders would actually accept the equity for debt swap offer. Now, to get that, normally we need to first of all understand how much they are expecting to get, and then how much they will be getting if you give them equity. So the bondholders were given their 13%. So looking for where they talked about them. Oh, they are here. 13% unsecured bond with the minimum nominal value of 40 million, redeemable at par in 10 years. So if you did the value, because now we are looking at another appendix. So appendix 4, value of the unsecured bond. Because what you are going to do is that you are going to determine how much they are valued, and then how much they are trying to give them, and then you see whether they will accept. Okay, so how much are they valued at? So they are supposed to be redeemable in 10 years. So from years 1 to 10, years 1 to 10, they will be getting interest, and the interest they are getting is 13. So $13 13% of the 40 million. Okay, we are going to still work in millions here. So they will be getting interest of 5.2 million. Here was 1 to 10. And then the 10th year, they'll get redemption. And basically, they will get back their redemption at par, so 40 million. So that's what they will get. Now, these are the cash flows. So we can now get our discount factors, and we are going to discount them at, let's see, what are we going to discount them at? The normal date of the normal cost of borrowing, which is 7%. Okay, this 7% here, the normal borrowing rate. So discount factor at 7%, which is going to be, because these are annuities. The first one, 1 minus 1 plus 7%, power minus 10 divided by 7%. So that is 7.023. And this last one is a normal discount rate of 7% for 10 years. So these are our discount factors. Then you can get our present value. So they are valued at about 58.6 million. That's their value. Now, the question is, because the question was asking us whether they will be acceptable, whether they will accept that. Now, if they are valued at 56.8 million, the only reason they will not accept that is that if what you are giving them is less than that, so now you need to go to what they are going to be giving them as the issues, the issues of shares, right? So when they are issuing shares, what are they going to do? So they are saying that they are going to they are going to issue 100 million shares, and 20% will be sold to the public, 10% will be offered to the holders of the anti-trust exchange, and 70% will remain. So now, what we are going to say is that, okay, there are two situations. One where we have the Bahari project not considered, and then one where they are going to consider it. So now we need to calculate what's going to be the share price of the company. So we may actually have to make another appendix here so that we know the share price of the new issue. We can even say possible share price because we are not certain this is the one that's going to happen. So now we are going to do this considering whether the Bahari project has happened or not. So if the project is not there, and then whether it's there. Now, remember they told us that they are issuing 100 shares and 100 million shares, but they are issuing them for the entire company, and then so the company value, so 100 million shares. So when the project is there, we saw that the value was going to be 569.5 million if there's no project. So basically that means that it's going to be 569.5 divided by 100. So it will be about 5.7 per share, okay, when there is no project. And when there's a project, we found that the value is going to be 581.14 divided by 100, which becomes 5.81 per share. Now this is at full price. Because remember, there is also something that they say that they may be willing, they want us to offer at a discount. So if we go to and offer it at a discount, what discount was told to us in the question? 20%. Which means that basically what you do is just get this one multiplied by 80%. So it becomes 4.56, and then this one 4.65. Now, because these people, their present value is 56.86 million this date, the only thing that they can accept for you to do, okay, to extinguish their debt would be, because remember, for them, they are getting how many shares? 10%, okay? So 10% of the entire company. So if the project is there, what will be there? So let's now put here the unsecured loan holders. Now for these ones, if it's at full price and you give them at 5.7, what will happen to their, what will they get? They will get 5.7 multiplied by 100 million shares, but they're only getting 10%. So they will get 56.95, which is okay because they are having 56.86. That will be fine. But if you get it at the project, they will get 58, which is fine, right? But at discount, they will now get only 45.56 and 46.49 respectively. Therefore, you say the unsecured debt holders will only accept the shares, the equity for debt exchange if the share, or if the issue over 100 million shares is not made at a 20% discount. Okay. Now, if you have time in the exam which you don't have, you would maybe figure out which percentage of discount would they be willing to accept, but you don't have that time. So you just calculate this and tell the examiners if you give it at a full price, they are going to get more than what their equity, what their value was for the debt. But if you issue it at 20% discount, then you're going to not meet their needs in terms of their value. They will lose value if you exchange their debt. Therefore, they won't accept. So that answers the other part of whether they will accept or not. Okay. Now we have another part which looks at the assumptions made expected in the share price range. So now we have actually done this part by looking at the possible share price rating, right? You see these share prices that we have put here. This is answering this part. Okay. So, and the assumptions that we are making there is of course the 20% discount. And then there's also saying, in addition to the reasons mentioned, remember the reason that was mentioned was that since they are remaining with a small they are giving a small proportion to the public, then they should issue at a discount. Now you should give other reasons for charging a discount when you want to list. So remember, I told you one reason was that when you issue at a discount, you give chance for your shares to actually go and increase value after the issue, which may be a good sign to the shareholders, which is difficult to happen if you issued at a premium. So that is that reason there. So another reason is that these guys who help you go public, we call them underwriters. So underwriters can be insurance companies, can be commercial banks, can be investment banks. For them, they help you to create some clout in the market by buying your shares. But for them, they don't want to keep your shares for the most part. They want to get those shares and then sell them after. So it means that if you give them at a discount, you are giving them a chance to make some profit on the transaction right away, which is going to be incentivizing enough for them to undertake your rights issue. And then, of course, they also want you to explain why you should go public. So why you should go public, first of all, it can help you raise finances very easily, but it can also help you streamline your operations, because when you're public, you have so much scrutiny that you are going to be able to, you have a lot of people looking through what you are doing. Those can help you kind of make sure that you keep your house in order. So those are some of the reasons that you would go public. So let's handle the last part, and then we go to the solution and see how some of these things have been laid out. So the impact on these ethical issues, the farmers' relocation. So of course, the farmers' relocation is going to create a problem in terms of how we handle it. Although it was not us who relocated the farmers, it was the government. But because we are going to be seen as being with the government, working with the government of Bahara, is it Bahara? Of Bahari, then it may create some bad image for us in terms of the reputation. So that's going to be a problem. And reputation damage can not only affect you in Bahari, but it can affect you even at your home where you come from, because when those people are now looking at you, they're like, this is a guy who went and worked with a government which is not having interest of his people at heart, and therefore they may mean that your minds are going to be like, you may not get business again for mining in the country where you come from, because people will not see you as being reputable. Then the relationship between Bahari and Mlimas, we can say there's kind of, would call it, let's say, you say on the part of the government, you can say that it can be some self-interest, because you are looking at a person who who you used to work with, is your friend. Therefore, you are not putting the best interest of the people at heart. You are just doing something for your friend. And it, depending on whether what the person is going to be doing ultimately is very terrible, if they are going to affect the environment adversely, then people will be saying, this guy brought his friend, and this friend did this and that. So it was going to cause some issues. So those are some of the points that we can make about the ethical issues. And then they are saying the impact and the response of, so how you need to talk about how Mlima should respond to those issues. Now, Mlima, in terms of relocation of the farmers, probably Mlima would suggest that the government look for another part of land which is fertile, at least the level that this land was, so that people who the farmers are treated very, very well. And maybe the issue about breaking the communities, maybe they should do it such that they take the communities to one same piece of land whereby they can still stay as they were before as a community and be able to continue their farming. And they should strongly come out and say they are against the acts that have been done of mistreating the farmers and the violence that was against them when they demonstrated. Because if they don't, then the community may see as if they were implicit in that. So they need good public relations so that they are able to calm down the spirits of the people who have been disadvantaged by this aspect. So that is very important. Then in terms of the relationship between Bahari and Mlima's chief executive, maybe the chief executive may actually recuse himself from the role so that the government is only giving these people the project because it is deserved, not because the CEO is a friend. Because if that's the case, then it's going to create some issues. So that's how you go toward answering that question in terms of the ethical issues. Is it clear? Are you able to make such points?
Yes.
Yeah. So let us maybe go to the solution and just see which other points we can pick from there. So they're saying that part B of this question is independent of part A because it's about ethics, and you should maybe do it first if you are clear on what is to be done. So that's the first answer tip that they are giving you on that. Then regarding the report, of course, the report, as we said, by now you understand when they say report to the board, you have to put the report to the board. And then this one, there was some aspects of initial public offering and then the price range and the implications. So they summarize the requirements. Then they go to explaining why we should use the ZWA's ungeared cost of equity. So they say that it represents the return to the shareholders if ZWA was financed entirely by equity and not debt. So, which basically compensates the business risk. So this required rate would compensate Mlima's shareholders as well, because since they are both in the same industry, they face similar business risk. Okay, so that's what they are saying there. Then when they estimate the value, of course, they estimate it from Appendix 1. They get about 11%. We have 10.9 something, which is about 11% in Appendix 1. And the value is at 564.3, Appendix 2, before the project. Then they explain that they did the project before looking at the tax shield and subsidies, and it is a negative. But when you add those two, then the project will generate a positive net present value of 21.5. I think for us we had 12. You may check and see that the reason is that for them they used 11%. For us, we kept on using 10.9. So there is going to be those differences. But even if that's not the only reason that we have 12 and they have 21, you should not worry, because that means that, you know how you use the on macro, if you skip some step somewhere, then you don't lose all the marks. And given that we have a point enough, we have a figure to discuss in this discussion, that is already fine. Then they try to split out the share price of the 100 million shares. So without the project and with the project, both at full price and at a discount. Then they talk about the unsecured bondholders. So their value right now is at 56.8 in Appendix 4, but they are given 10% equity. Then the only share price they want is 5.86. That is the one that is going to be acceptable to them. So if they make it at 4.51, then they would need to be offered around 4.6 equity stake, as opposed to just 10%. So, and they are assuming that they are using 7% flat yield, which is the one that they would borrow at the current yield. So then assumptions that have been made, they are here. Of course, is the accuracy of the information, which is the one that I tell you, you always give it in any question, because the question is that you have assumed that 200% increase in revenue, those kinds of things, are they going to happen? Okay, so future growth rates, profit margins, future tax rates, and capital investment. And they didn't tell us how they are computing them. Even we are projecting for 15 years, so it's a lot of time. You can see that they're still talking about the assumptions. And you don't have to write the entire big paragraph like this. You just have to write the fact that the assumptions that have been made is the accuracy of the figures, and you say if the figures are not right, then it may affect the results. Then you give a few examples there. Also, we are using the ungeared cost of equity, thinking that Mlima has similar business with that company that we used Ziwa. However, because Ziwa is listed and Ziwa is bigger, they may not have similar business risks. So also, when you accept the project of Bahari, the risk is going to change. And then also, we have assumed that the values are going to be when the government gives us the subsidized loan. Now, if the government doesn't give us that subsidy for the next 15 years, it may affect our NPV result. Also, underwriting costs have been ignored, or they have assumed not be significant. Also, the issue costs for the debt. So then they give some reasons for you to list, which including to use the funds to eliminate the debt to the company. Then the other reasons can be higher reputation by being listed, which we talked about. Then being able to raise funds easily in future when you want new projects. Then also the current owners, they get value for equity stake. And then also the current owners can sell their equity stake and gain from the value of the organization. So those are the reasons for a listing. And as usual, you should not put these ones in one paragraph like this. You should put them in separate paragraphs so that they are easily visible. And then it helps you to also score marks for being organized. Then when it comes to issuing shares at a discount, so it makes the shareholders, makes the public shareholders. So, and then, but they will become minority shareholders because they are only issuing 20%. So it means that the company would be severely curtailed since the new investors will not really make a decision. So since the majority is staying with the current owners, that's why they are saying, okay, issue it at discount. So the discount will now reflect additional risk to those investors. That's one case. And then the other reason is that it can ensure that they do get sold at the reward for the underwriters. So those are the two reasons that you can give. And then they, of course, conclude by summarizing everything. Okay, they are saying that the share price will be between 4.5 and 5.86. And if we issue 20 million shares to the public at 4.5 each, then we shall raise 90 million. And if the 80 million are spent in paying the secured bonds, then we only have 10 million that remain. And remember, Mlima needs 150 million, so we may need to get another 140 million from debt, from the subsidized loan, that kind of thing. So, and then they go to the appendices, which you shall get time and look at and see how they followed, see if they are making any calculations different from ours. I'll leave that to you. And then the ethical part, as the last part of this question, of course, they say that now that when you are listed, they will be scrutinized more. And therefore, we should consider that we should make sure that we respond appropriately to these kind of issues. So the first one of the relocation, we need to also look at the ethical code to see how far our responsibilities will lay. But you see, because this matters between the farmers and government, it's not between us. but the mining rights will be assigned to another company should we decide to walk away from the deal. Therefore, even if we don't agree with the project, then the other people will suffer the plight. This is something that people always use as an excuse for doing bad deals. That even if I don't do it, somebody else will do it. But what you have to do is that try to influence the government to respect the farmers. So keep them together, give them better land, like we have said. And also, you may also decide to train them so that they can be able to work in the new, instead of going to the farm. So the second one, because it makes sense to force strong relationships, but it's going to create some issues whereby maybe there was bribery or illegal practice. Now, if you can demonstrate that it was in the best interest of the company and the country without having those people having work together, then that may be okay. But you need to have strong PR so that you can be able to demonstrate that acting in according to ethical code, preempting media scrutiny, and also the issue that we discussed of saying that the person also may step down so that it doesn't seem like it's because of him that the project is going to go on. So it was a long question, but I hope that you have benefited from the computations and also the theory that is listed in here. I don't know if you have some questions for me before we leave.
I don't have any question. Thank you.
Okay, welcome. So have a good day. See you tomorrow.